In this video, we're breaking down how taxes work for LLCs versus individuals and why it matters for small business owners. What's going on, everyone? My name is Eric Hunsaker, and here we cut through the fluff to help you make smarter decisions about business and your finances. Now, if you've ever wondered why some entrepreneurs talk about pass-through entities while others deal with corporate taxes, or why two people making a similar income pay very different amounts in self-employment taxes, the answer usually comes down to business structure. By the end, you'll know the key differences between personal and LLC taxes, the default rules, and the options LLC owners have to save money and reduce headaches. Basics of personal taxes for sole proprietors. If you're running a business on your own without forming a separate entity, you're a sole proprietor by default. In the eyes of the IRS, there's no distinction between you and your business. So here's how taxes work in that scenario. Reporting income on Schedule C. Sole proprietors report business income and expenses on Schedule C, which is attached to your Form 1040 individual tax return. Schedule C lists your gross receipts, cost of goods sold, if applicable, and deductible expenses such as supplies, travel, and advertising. The net profit, income minus expenses, flows to your personal tax return and becomes part of your adjusted gross income. Paying income tax and self-employment tax. Sole proprietors pay income tax on their business profits and their individual tax rates. But there's another layer, self-employment tax. Because sole proprietors are self-employed, they must pay both the employer and employee portions of Social Security and Medicare taxes. The self-employment tax is currently 15.3% on the first $160,200 of net earnings as of 2023 and 2.9% on income above that. There's also an additional 0.9% Medicare surtax on income over $200,000, $250,000 for married couples, and you can deduct half of your self-employment tax on your 1040, but the tax still affects cash flow. Estimated quarterly taxes. Because no one is withholding taxes from your income, sole proprietors must make estimated tax payments every quarter. These payments cover both income tax and self-employment tax. If you underpay, you could face penalties. Proper bookkeeping and planning are essential to avoid surprises at tax time. Unlimited liability. One reason people form LLCs is liability. Sole proprietors are personally liable for business debts and lawsuits. That's not a tax issue, but it's related to why many entrepreneurs choose to form LLCs and then ask how taxes will change. How LLCs are taxed. Default classification. A limited liability company, or LLC, is a legal business structure created at the state level. From a federal tax standpoint, LLCs don't have a default tax classification on their own. Instead, the IRS classifies them based on the number of members and elections made. By default, a single member LLC is treated as a disregarded entity, taxed like a sole proprietor, and a multi-member LLC is taxed as a partnership. Single member LLCs, disregarded entities. If you form an LLC on your own, the IRS disregards the entity for federal tax purposes. You report business income and expenses on Schedule C, just like a sole proprietor. You pay income tax and self-employment tax on the net profits. The difference is in liability. Your LLC protects your personal assets from business liabilities, assuming you keep business and personal finances separate. From a tax perspective, nothing changes unless you elect a different classification. Multi-member LLCs, partnerships. If your LLC has two or more members, the IRS treats it as a partnership by default. Partnerships file Form 1065, U.S. Return of Partnership Income, which reports the partnership's total income deductions and credits. The partnership itself does not pay income tax. Instead, it issues each partner a Schedule K-1, which shows their share of the profits and losses. Each partner reports the K-1 amounts on their individual tax return. Partners also pay self-employment tax on their share of profits, subject to the same rules as sole proprietors. Like partnerships, LLCs taxed as partnerships enjoy pass-through taxation, avoiding corporate-level taxes. Pass-through taxation, explain. Pass-through taxation means business profits pass through to the owner's personal tax returns. There's no federal income tax on the business entity itself, with certain exceptions, which we'll discuss. Owners pay tax on the income at their personal tax rates. Pass-through entities include sole proprietorships, partnerships, S corporations, and most LLCs. This is different from C corporations, which pay corporate income tax and may cause double taxation when profits are distributed as dividends. LLC Tax Election Options. The beauty of the LLC is flexibility. Owners can choose to be taxed in several ways depending on what benefits them most. Here are the options. Electing S corporation status. LLCs can elect to be taxed as an S corporation by filing Form 2553 with the IRS, and sometimes additional state form. An S Corp is still a pass-through entity, but it treats owners as employees for salary purposes. The owner must pay themselves a reasonable salary subject to payroll taxes. Social Security, and Medicare. Any profits beyond the salary can be distributed as dividends, which are not subject to self-employment tax. This structure can save money on self-employment taxes if your business earns more than what you'd reasonably pay yourself in salary. For example, suppose your LLC generates $100,000 in profit. As a sole proprietor or default LLC, you'd pay self-employment tax on the entire $100,000. As an S Corp, you may pay yourself a $60,000 salary, subject to payroll taxes, and then take the remaining $40,000 as a dividend, which is not subject to payroll taxes. This could save you thousands in self-employment tax. However, you must run payroll, file quarterly payroll tax returns, and prepare additional tax forms for the S Corp. Also, you must ensure your salary is reasonable. Too low, and the IRS may reclassify dividends as salary. Electing C Corporation status. LLCs can also elect to be taxed as a C Corporation by filing Form 8832. In this scenario, the LLC becomes a separate taxpayer. The corporation pays corporate income tax on its profits, 21% federally as of 2023. And when the corporation distributes profits to owners as dividends, those dividends are taxed again on the owner's personal returns. This double taxation is often a drawback. However, C Corps allow benefits like deducting employee health insurance premiums and retaining earnings for growth. A C Corp election might make sense if you plan to reinvest profits into the business, attract investors, or eventually go public. Staying with default classification. Most small business LLCs stick with the default classification. Single member LLCs taxed as sole proprietorships, and multi-member LLCs taxed as partnerships. This structure is simple and avoids corporate formalities. It's often best for new businesses or those with modest profits. Personal taxes versus LLC taxes. Key differences. Now let's compare how taxes work for individuals versus LLCs with different tax elections. Separation of personal and business income. One of the primary differences is the separation of your business income from your personal income in bookkeeping and reporting. As a sole proprietor, everything is lumped together on your personal return. With an LLC, even if taxed the same way, you have a distinct legal entity. Maintaining separate bank accounts and records is required to preserve liability protection and simplify accounting. This separation can also clarify deductions and help you plan for quarterly taxes. Self-employment tax implications. Sole proprietors and default LLC owners pay self-employment tax on all net profits. This self-employment tax represents both the employer and employee portions of Social Security and Medicare taxes. With an S Corporation election, the owner only pays employment taxes on their salary, not on dividend distributions. A C Corporation bypasses self-employment tax entirely because the owner is considered an employee and takes a salary subject to payroll taxes. Dividends are subject to dividend taxes, but not Social Security and Medicare. Difference can be significant depending on profits. Deduction opportunities. LLCs and sole proprietors can deduct ordinary and necessary business expenses, office supplies, advertising, professional services, travel, home office, mileage, and so on. These deductions lower taxable income regardless of structure. However, an LLC offers the chance to formalize expenses and separate them more clearly. Electing S Corp status may allow you to deduct health insurance premiums and certain fringe benefits at the corporate level. C corporations have more flexibility in providing benefits like retirement plans and health insurance to employees, potentially leading to tax advantages for owner employees. Qualified business income deduction. The 2017 Tax Cuts and Jobs Act introduced the 20% qualified business income deduction for pass-through entities, including sole proprietorships, partnerships, S Corps, and most LLCs. If you meet income and eligibility requirements, you can deduct up to 20% of qualified business income from your taxable income. The deduction phases out for high-income taxpayers in certain service businesses, but it can significantly lower taxes. C corporation owners do not qualify for the QBI deduction because corporate earnings are taxed at the corporate level. Understanding whether your LLC qualifies and how to maximize this deduction can make a big difference. Payroll taxes and reasonable compensation. For S Corp owners, paying yourself a reasonable salary is a requirement. Salaries are subject to payroll taxes, Social Security, Medicare, and unemployment taxes. The IRS expects you to pay a salary comparable to what you would pay someone else doing your job. Owners sometimes try to set a low salary to maximize tax-free dividends, but this risks an IRS audit. Determining a reasonable salary requires considering industry standards, hours worked, and responsibilities. Sole proprietors and default LLC owners do not pay salaries to themselves. All income is subject to self-employment tax. State tax considerations. State taxes vary widely. Some states impose personal income tax, but no separate entity level taxes on LLCs. Others, like California, charge an annual franchise tax on LLCs, a minimum of $800, plus a gross receipts fee for higher incomes. S corporation owners in California pay a 1.5% corporate tax on net income. income. States like Texas and Tennessee have franchise or excise taxes based on revenue or net worth. Also, some states recognize S-Corp elections and others do not, treating S-Corps like C-Corps. It's critical to consult a tax professional who understands your state's rules before making an election. Decision making. Which tax structure to choose? Deciding how to tax your LLC depends on various factors. Income level. The more you earn, the more tax planning matters. At moderate profit levels, default taxation is simple. When profits exceed the reasonable salary you'd pay yourself, an S-Corp can save on self-employment taxes. Nature of business. Service businesses with low overhead may benefit more from S-Corp status. Product businesses or those requiring reinvestment might consider a C-Corp. Expansion plans. If you plan to seek investors or go public, a C-Corp can simplify capital raising. S-Corps have restrictions on the number of shareholders and classes of stock. State taxes. State-level franchise taxes, excise taxes, and income taxes vary. In some states, S-Corps pay lower entity-level taxes than LLCs. In others, there's little difference. Research your state's rules. Administrative appetite. Running a sole proprietorship or default LLC is simpler. Electing S-Corp or C-Corp adds payroll, additional returns, and compliance requirements. Make sure the tax savings outweigh the administrative burden. The difference between personal and LLC taxes hinges on how your business is structured and the elections you make. As a sole proprietor, your business income is simply part of your personal income tax return, and you pay self-employment taxes on all profits. Forming an LLC gives you liability protection, but doesn't change the tax treatment by default for single-member LLCs. Multi-member LLCs are treated as partnerships. Electing S-Corporation status can reduce self-employment taxes if you pay yourself a reasonable salary and distribute the rest. Electing C-Corporation status separates your business taxes from personal taxes, but introduces double taxation and additional complexities. So there's no one-size-fits-all answer. Assess your income, business type, growth plans, and state tax rules. Talk with a knowledgeable tax professional before making any election. Proper planning can save you money and set your business up for long-term success. Now, if you want to get started with setting up your LLC or holding company, you'll find links down in the description below. These are affiliate links, which means we earn a small commission when you use them at no extra cost to you, and these commissions really help support the channel and allow us to continue to create free content just like this. So if you end up using it, we really appreciate it. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you never miss another video. Here on the LLC channel, we cover everything you need to know about forming, managing, and scaling your LLC or holding company, plus smart tax strategies and business tips to help you grow. So be sure to subscribe. But other than that, thanks for watching, and we'll see you here in the next video.